All right, this is part two of the 2022 housing market prediction video series that I'm doing here. We're going to talk about foreclosure futures today. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. The realism back in real estate. Hope you're doing well. We'll continue with this mindset as to what's going to happen because you know what? It's like rolling the dice. Nobody knows. Who knows what's going to go on, right? So again, video number 2 for the second prediction. Today is actually kind of interesting because we're going to look at the foreclosure market and how that's actually going to affect the housing market. So really, we haven't seen too much going on because of the situations, which we'll explain. It will pick up. Will it have any effect? That remains to be seen as to how this unfolds. So it does make sense, though, that where we're situated today, this video is brought to you by our friends at foreclosure.com. So if you'd like to find out what's going on in your neck of the woods, your backyard with respect to distressed properties, foreclosures, short sales, auctions, tax deed issues, the whole bit, go to gethousingdata.com. That's gethousingdata.com. Check it out. There's a 7-day free trial. It's very inexpensive, but gives you a good snapshot, litmus test as to what's happening in your actual local market, because this is where the place is, or where to go to find deals, because you're not going to find them on the MLS. You're not going to find them with your real estate agent. Not going to find them on Zillow. All right. So this doesn't work that way anymore, guys. So we got to go down the path. So anyway, foreclosure market status. So really, this is not discussed in mainstream media. And why? Because it's not part of the current housing narrative. It's not considered for future value. So when we talk about home price appreciation and by what double-digit number values are going to go up this year, nobody ever mentions this foreclosure volume that really hasn't been exposed to the elements yet, so to speak, and hasn't manifested itself, but it's starting to, and it will, but no one talks about it. Now, reason being, they want you to forget about it. So if I'm Wall Street, if I'm the lenders, if I'm big mortgage companies, and I want values to remain high, I don't want you to know about this. I want you to think that I got to go buy that house now because someone else is going to buy. It's competitive. It's going to go up another 10% next year, double digits. I better buy it now before I lose out. And FHA increased loan limits and mortgage rates are going up. So there's pressure for me to buy here. So they want you to not think about this potential foreclosure distress market area or a part of the overall housing market. Okay, I think it's really, again, what's been happening the past year and even the past few months with the media on anything. So many narratives, so many things are being spun which way and that. So who do you believe? So the more you talk about something, you believe something over here, the less they talk about it on this side, you forget about it. So that's what they want to have happen. They don't want you interested in this market. Why? Because big money people want to get at it first. All right. So the media is very quiet regarding what? Forbearance statistics. We used to have weekly stats from Black Knight Financial. I'm sure, I guess you can find them, but they're not advertised that way anymore. Frankly, I don't care about them anymore because forbearance is ending, and the forbearance ending started in August. So people are now coming out of forbearance programs every month now till the end of the year, and also from January 2022 going forward to probably about halfway until 2022. So guess what? There's stuff's happening, okay? But we're not talking about it right now because it's not relevant at this point in time. So foreclosure stats, again, difficult to talk about foreclosure stats. Number one, it's a tough number to get your hands around and figure the stats. But again, because of the things that have happened, not much has happened or didn't happen. Not much is happening in that realm as well too. Now, it's also spun as a problem that's already solved. What I mean by that is that any potential foreclosure or distressed property situation has already been solved because the market has so much equity and so little inventory that guess what? All you have to do, sell your home, cash out, walk away, pay your debts, and everything's good. Now, where you go next, who knows? Where are you going to live? Who knows? You're going to buy, you're going to rent, like what's going to happen? I don't think people are talking about that. Not their concern, but all they want the market to believe that everything's okay. Distressed properties are going to make no impact as to what's going on right now in housing. So again, something to keep in mind here. So the problem with the foreclosures is that you can't quantify the volume, and this really is important because back when quantification is like, well, how much distress are we going to have? When's that going to be available? Well, it's tough to really figure out. Now, back, when we started hearing about all this, I remember, the fall of 2020, I would, attend a bunch of webinars, and I would hear different numbers, 1.5 million potential and 2 million, 2.5. So we've seen numbers being bantered around by different sources and different groups, whether they're data companies, whether they're extrapolating, whatever the numbers are. Excuse me, I've seen numbers between 3 million potential foreclosures all the way up to 10 and above potential foreclosures. All right. As a matter of fact, the White House even came out in a press release and said 10 million foreclosures are potential out there. So, again, I debunked a little bit about that, but really, it just goes to show that there is this vast difference in a number, and I really believe the number is trying to be downplayed right now. It's supposed to start now, so it isn't 2022. It's going to go on for a couple, 2, 3, 4 years. So we're looking at, 2022 to about 2025, where all this is going to kind of erode and mess around, etc., with the marketplace. Now, there is no absolute source for numbers, so that's the disadvantage we have. We just have to take the stats that people give us and look for angles, etc., where the numbers are, the best as we can, and make our own assumptions. I can tell you that, doing this for 10 plus years and looking at stats for on this exact topic for 10 plus years, that it's the numbers typically are underreported, whether by design or just by the nature as to that's the way it's been done on their calculations. Who know? But pretty much what we hear in the media, think of it as always more. All right, stats, are based on samples and extrapolations. Yeah, we sometimes get certain pay counts, etc. But a lot of stuff that's talked about really is just people are taking a quick snapshot, making some assumptions, and sort of blowing that up to a larger number, and that's where we're at. So also, you're going to hear the average foreclosure time frame or time to foreclose has also increased. Well, that would tend to make sense. Why? Because when we had a moratorium on foreclosures, they weren't foreclosing. When people who should have already been in the foreclosure process that are delinquent in their mortgage weren't being processed, well, that adds to the time frame too. So some of this, and that's some of the I guess we'll say narrative too. They'll say, well, the average time to foreclose is 941 days. So clearly homeowners have time to sell their property. Well, that was then, and that's because of the situation we're in. I can tell you now that, foreclosures that are going to get filed now are going to move through the system a lot faster, because there's no reason for the courts or the lenders to have them go so slow. It's different than last housing crisis. Before, they were trying to figure out and deal with their massive debts and loss and issues. Now they go, we just want to sell this thing as quick as possible and get our money back. So you see different perspectives, and I guess you could say different influences will move the market, the foreclosure market, timeframe market, as it needs to be. So so people will simply sell. That's part of the narrative. You just sell. You'll just sell. You got all this equity. You're going to sell. Why bother to sit around? Sell. As I said, where you're going to go, you're going to buy or rent. Who knows? But you're going to sell. Lenders will simply modify loans. So every person that's in forbearance or has a foreclosure, lender's just going to modify your loan for you. We got all these programs out there. You just jump in. You pay it back when you sell. Not a big deal. Blah blah blah. Well, it's not as simple as that. But again, from the mainstream and the narrative, it seems like it's already a done deal. There's going to be no market impact. So all the stuff we talk about here have no impact on the marketplace. So don't even worry about it. That's why, again, don't bother with this stuff. Just go buy that expensive house. That's how we're being positioned, which really is not a good thing. And I don't like that on a personal note. I like to know what's going on. So this just came out the other day, and I want to talk about how titles can be deceiving. So this is from Adam Data Solutions, and I think they're reasonable with respect to their information. U.S. foreclosure activity drops to an all-time low in 2021. Now, back in the fall of 2020, I was listening to some of the webinars from Adam, and I felt that they were one of the groups that was being reasonable with respect to their position on things. Well, fast forward to where we are today, it's actually over the past year, they've changed their tune. They're speaking out of both sides of their mouth right now. Okay, what I mean by that is, again, U.S. foreclosure activity drops to an all-time low in 2021. So all-time low. Oh my gosh, that must mean if you're just a normal person, a normie who wants to buy a house and doesn't get involved in investment or even look at these stats, you're going to go, oh, look, we have an all-time low in foreclosures. that must mean there's no market impacts. Everything's good. I better buy my house now, you see? So no one is triggering or figuring out going, what about all the stuff that's happened over the past couple of years or hasn't happened? That's going to play out? Where's it all going to go? All right. So I guess that's the interesting thing here. So titles can be deceiving. And I think these guys now are starting to spin that. Like, this is your title, so you go right ahead and you feel good about yourself. But when you start to actually read what goes on, so of course, the COVID foreclosure tsunami that some people had anticipated is clearly not happening. Well, of course it's not happening because it hasn't been allowed to happen. All right, so it's not like it just, and again, government and mortgage industry efforts have prevented millions of unnecessary foreclosures. Well, that's kind of a loaded statement right there from the EVP of Realty Track, which is an Adam company. All right, and I've listened to this guy on I guess on some webinars and stuff. And listen, I have nothing against these people whatsoever, but I just find that where we are today, it's people are spinning things a little differently now. So what he's basically saying is that the government and mortgage industry efforts have prevented millions of unnecessary foreclosures. Well, they haven't prevented the foreclosures. They've just put them on ice. Okay, they've bought time for people. They haven't prevented foreclosures whatsoever. The foreclosures are going to happen. It's just a matter of when and at how much volume. Okay, so basically, this is called kissing ass, government and mortgage industry efforts, because guess what? Who's their client base here, right? Come on, right? So this is why, and while it's likely we'll see a slight increase in the first quarter, we probably won't see foreclosure activity back to normalcy before the end of 2022. Well, it's right, because things have to catch up and things have to get back in play, and the process has to start again. So, what they're basically saying here is that it's going to be slow. We're going to see some increases, but it'll get back to normal by the end of the year. So, again, reading into that means we're going to be back to normal by the end of the year. Okay, normal market with foreclosures. Now, again, the government's foreclosure moratorium, the mortgage forbearance programs, and the mortgage servicing guidelines enacted by the CFPB, the Consumer Finance Protection Bureau, in August have kept foreclosure starts artificially low over the past year. Okay, so now they're coming out saying, yeah, it has been artificially low. But you got to read it to find out, right? While the recovering economy should prevent a huge increase in defaults, we should see a gradual increase in foreclosure activity as these programs expire, and as servicers exhaust all loan modification options for delinquent borrowers. Well, we should prevent an increase in defaults. That would be the utopia. That's what everybody would like, but it's not going to happen. All right, and we'll talk about that in a few seconds here. So just so we're clear where we're at, and this is part of the stuff that bothers me to no end, and that's why I like to talk about it, is that, low over the past decade, whatever, but in the same article, the Q4 foreclosure activity, the high-level takeaways are, foreclosure filings were up 23% in Q4 of 2021 from Q3 of 2021 and up 82% from a year ago. So, you know what? Even though we were at the all-time low, we're already seeing increases in activity. So we're at the starting point, the cusp of an increase in activity. So let's make sure that we're all on board with that and we understand what they're saying here. So again, as I say, we won't get fooled again. We've had 2020 and 2021 are obviously ridiculously low volumes of foreclosure numbers, and we should see them pick up as the time goes on. All right, so don't worry, they're coming. It's a matter of time to get our hands on them and figure this all out. But hey, first of all, if you guys are not a subscriber and you appreciate my video and information, please smash the subscribe button. I'd really appreciate that. And also, if you are a current subscriber, do me that favor and just try to subscribe again, because I'm losing more subscribers than I'm putting on. So again, thank you very much for all the views, likes, comments, etc. It helps me figure this stuff out and actually do what I want to do. Okay, so thank you to you guys. Okay, let's move on here. Interesting stuff, as I always say. There are two housing markets in play right now. So listen, I'm not an idiot. And I know I see some of the comments people make. It's like, do you think that I don't know what's going on in the real estate market? All right. So come on. All right. Yeah, I've been talking about housing bubble for 3 years now. So do we have a housing bubble? Yeah, darn right we do. Do we have bubbles and other things going on right now? Of course we do. All right. There is a housing bubble. No ifs, ands, or buts. People way, way smarter than me with way more experience and with millions and millions of more dollars buying stuff up. They know what's going on as well, too. And they're all in agreement we're in a housing bubble. the I guess question is, and the real crux of the whole thing is, how is it going to play out? All right. So we have the mainstream retail market, which is housing narrative, growth, low inventory, double-digit appreciation. Everything's good, good, good. Buy, buy, buy. Then we have the shadow inventory, which is behind the scenes, which isn't quite available to the retail buyer. It never really is, but it's there and it's growing. It's going to manifest and it will contribute to the marketplace starting really right now. Okay, a little bit in the fall, in December, but now we're going to start to see some material pickup and what's going on in the distressed shadow inventory. So please keep this in mind. So now we start seeing things that, foreclosures soar 94% from a year ago. Well, that's different than seeing nothing or no information on it, right? Foreclosures, more borrowers are losing their homes now than they were earlier in the pandemic. That's right, because pandemic, nothing. Now, when we actually getting back to or moving towards a normal monthly, yearly market, we're going to start, of course, the first couple of months of change will be dramatic like this. I'm not saying that every month we're going to see 94%, but when things start, bang, it swings up, of course, like that. So I'm not running with that saying, look, the world's coming to an end. I'm saying be aware, okay? Things are starting. Now, this is interesting, okay? The debacle adds to a string of defaults and distress. So really, after offering protection for homeowners for nearly 2 years, New York State's moratorium on foreclosures is set to expire this past Saturday. And data shows 14,500 Long Island borrowers are seriously behind on their mortgages. So here's the thing here, guys, is that because, even though the federal moratorium on foreclosures ended in end of July, and the eviction moratorium ended as well too, and most of the states are opening up now. There are pockets like New York State and LA County, whatever, that really have their own overlay as another moratorium. Well, it's ending now, right? So put it this way, 14,500 Long Island borrowers are seriously behind on their mortgages. Okay, seriously behind means 90 days plus. Okay, 3 to 4 months and greater. Most are going to be greater. So that's not 500 or 1,000. That's 14,500. So, and I know based on stats and what I look at, that whole New York City has a whack of them. The whole New York City, Connecticut, New Jersey, Long Island area, massive amount of pre-foreclosures. Okay, massive amount. So is everybody going to sell at once? Well, what happens if everybody sells at once? Changes the marketplace, right? So anyway, people will try to sell. People will try to help themselves, but it's not all going to end pretty. Others who pulled money out of their homes through refinancing home equity lines of credit may not have that option. You see, so right now when they say sell your home, premium dollar values, that means that to me means, well, if you're going to sell up there, your home better be available to be up there, like with new roof and new kitchens and updated whatever. Okay, to get the big money, you got to already put the big money into it and be ready to sell. It's not going to happen for most people, by the way, guys. But the point, though, is that these are the type of numbers that are out there that nobody talks about. And we're going to start hearing more about that, all right? So, interesting. Just for fun, I pulled the information this is the foreclosure auction calendar for Broward County, which is the Lauderdale area, and Miami-Dade County, which is obviously the Miami area, okay? So take a look at Broward County. So in December, 179 auctions were scheduled. In January, we have 388. Okay, so December is, granted, a little bit of a slower month, and January tends to be a bit of a higher month because people don't normally you don't see many foreclosures over the Christmas holidays, and then the lenders come back with a vengeance to the courts in January. So usually a big swing, but I wanted to show you. Look at the swing: 179, 388. That's not 10 or 50 or 75. That's 179, which is a pretty good number already, up to almost 400 in January. Okay, look at Miami-Dade, down to 150 in December, so things really slowed down. January's numbers, 444. Okay, very populated county, a lot of activity goes on there. So my point to you is that it's starting. Okay, so there was stuff happening beforehand because Florida was opened up, all right, but now everything's pretty much opened up. And any last, we'll call it restriction, that would have affected us down here, which would be the CFPB, the Consumer Finance Protection Bureau, saying you can't start a foreclosure filing on someone who came out of forbearance until 2022. Well, it doesn't affect these numbers, but everything's opened up now. But again, going from 150 to 444, this goes to show you there's pent-up inventory demand that's going to come through on the distressed housing side. So this is, I guess you could say, not good for the homeowner, but good for people who want to buy, invest, etc. So this is what we look at. All right. So again, proof positive, the numbers will be increasing. All right. Now, I find this to be very interesting as well, too, because going back to the narrative where it says people are going to go to their lenders. Lenders are going to help them. Everything's going to be so good and rosy and flowers and whatever. It's not going to happen. Okay, so about 50% of seriously delinquent homeowners lack a loss mitigation plan. That basically means you're not paying your mortgage, you're behind your mortgage, you're delinquent, you're seriously delinquent, you could be in forbearance or maybe you're not anymore. But the point is 50% of these people, of these homeowners, don't have solutions. All right? So, and again, going back into statistics and underreporting, if we're talking 50% here, I know darn well that number is actually a little higher than that, probably 60 to 70%. Okay, so really more than half of the people who are delinquent haven't got a plan or haven't contacted their lenders or don't know what to do, which means the longer they wait, the worse they're going to be in, and they're going to lose their home to foreclosure. Okay, thus the opportunity. Okay, but I want to make sure that it says with protections that prevent servicers from initiating foreclosure about to end, concerns about a sharp uptick in foreclosure starts in the new year are rising. Okay, unless mortgage servicers can successfully execute home retention options, millions will face the prospect of selling their homes or losing them to foreclosure. Okay, so that's obvious, and I'll tell you, more will lose than will sell. All right, so please keep that in mind because it's important. We just talked about that. All right, so get this here. Now we talk about back to the forbearance. Well, one additional, sort of the additional 800,000 borrowers still in COVID-related forbearance. So starting in August of 2021, people came out of their forbearance. About 1.2 million, according to Black Knight, from August to end of December, and we got about 800,000 for the 2022. And again, conservative numbers, underreported numbers, samples, and extrapolation. So again, the numbers are actually bigger, but that's what they're telling us they have here. So out of those numbers, seriously delinquent loans, 471 are backed by the Federal Housing Administration. Okay, so FHA type loans. Well, but wait. Okay, why do I say but wait? Well, remember that I used to, I didn't produce it. I would do a video every so often, every month, about FHA loan delinquencies. Well, guess what? As of November 1st was the last month they produced that report, or they put it online that we could see. And again, I'm looking at one website where I get it from. Maybe it's there and they've not updated, but that was based on October's data. And it was showing that some of the delinquencies or serious delinquencies were going down. Now, again, we're seriously delinquent. We're at the 10% area range, whatever. Well, our insider information back a few months ago, probably around July, was saying that that's again is a low ball, that they really think the number is about 25%. Okay, so just again going back to stats, that we don't get told what's really going on. So, and again, if they're not producing the report, either they're not interested anymore, or maybe numbers are worse than they think and they don't want to show us. That's how I always look at these things. And then at the bottom here it says private label and portfolio loans, so stuff that don't qualify for loss mitigation plans on offer by U.S. government. The percentage of those borrowers taking home retention options amount to only 20% and 35%. So really, out of about 533,000, to their numbers, people who are seriously delinquent, guess what? They basically are, we're probably talking maybe a couple 100,000 are in, maybe even less than that. Maybe 150,000 are in retention programs. Okay, under 200,000. So, which is loan mods, loss mids, whatever type of thing. So, which still shows that the majority of more than half would be exposed to foreclosure filings, proceedings, whatever. So again, keep that in mind. So all these things, when the information comes out, it's not as rosy as we think it is, or we're being told, and that's why this is what's going to happen in the future. That's why I've been talking about this for a couple of years. I'm very bullish on this because I've seen it happen before, track it constantly, and we sort of know what's going to happen. All right. So just again, I'm not blowing smoke here. This is actually like real stuff. All right. Okay. This is even better. Okay. So going back to the fact that there's forbearance and loan modifications a whole bit. So basically, it says the liberal policy brings the return of the zombie mortgage. Well, what they're basically saying here is that house prices have risen so sharply that lenders on average generating twice the proceeds from foreclosure needed to pay off the mortgage note and other expenses. Okay, which is good for them. But essentially, the Federal Open Market Committee deserves the credit for destroying affordability for millions of Americans, but progressive deserve recognition too. So I guess it's somewhat political we're talking about here. By keeping families in homes they cannot really afford, and you create a new category of zombie debtors like those seen in the 2008 financial crisis. So this guy's talking about this is like the last housing crisis, okay? State and federal prohibitions on foreclosure will make the problem fester. Taxpayers will foot the bill. Okay, so they're going back as well. Two worrisome trends demand watching. Redefault of residential mortgages modified during COVID loan forbearance, and growing morbidity in urban multifamily real estate. So going to the redefault. So basically, if you get a loan mod, so you get reworked for a loan modification, what they're saying here is that the services are telling National Mortgage News, which is the author company here, that they think 20 to 30% of all residential mortgages that were modified over the past 18 months will eventually redefault. Back in the last housing crisis, lots of modifications were done. Tons of them redefaulted and became foreclosures again. So they're being conservative here, saying, well, if we're going to help 200,000 people, expect maybe, a good 40, 50,000 are going to pop back into that foreclosure bucket because they're going to run their modified plans for a couple of months and they're going to redefault again. That's an issue. Okay, so that does happen. Well, again, going down this path here, because this is interesting, I want to state that there is something to talk. But another but wait here. What does that really mean? Well, I've talked to a few people who are in the loan modification business, and the average numbers of redefaults are more like 50 to 60%. So this article's downplaying it by half. All right, and you've got we know the majority of people, or at least half the people that do go into a modification plan on their mortgage redefault. All right, so think about this. Lots of foreclosures are going to happen. 50% of the people don't have any sort of solution or loss mitigation plan in place. All right. Those that do, we're probably looking at 30, 40, 50% of those people redefaulting and going back in the foreclosure bucket. So you see, this is just a manifestation and a snowball effect of what's going to happen now that our economy is still not that great. Inflation's going up. It's to be tighter for a lot of people. What are you going to do? So and the issue now is people are going to stay in their homes longer. So home ownership tenure is increased every year for the past couple of years. But in this situation, these people are putting this off on doing anything to the last minute. Why? Because they don't have the money, and the longer they stay, they think they're banking or getting it for free, and it saves them paying the piper down the road. You know what I mean? So it's that sort of, it's kind of damn if you do, damn if you don't, right? I need to find a solution. The minute I find a solution, I got to start paying for the solution. I don't have the money for it, so if I don't pay for it, I extend my time on my property a little bit longer. I'm thinking, but I'm now at more risk at losing it. You see? So vicious circle, which is not good, but that's a situation we're in right now. So that's why, we don't talk about this, or the housing narrative mainstream does not talk about this. That's why the foreclosure problem will be a bigger problem than anybody even understands or estimates at this point in time. All right? It's kind of obvious when you start peeling back the layers. So my sort of predictions, where are we at here? Okay, let's finally get to this. I know I yacked for 27 minutes so far, but it's important. This is a big thing for this year. Foreclosures will increase. We see them already increasing. Everything has opened up now from the initial filing, so new foreclosure fines getting on the docket, to the processing of stuff that was in play beforehand, to foreclosure auctions picking up as we see. Okay, now not many will come back on the market. Why is that? Because the investor groups, Wall Street, other big investors, have been waiting for this to happen. Okay, so for them to go and buy distressed property at the foreclosure auctions, where they can outbid you in an appreciating marketplace, is like utopia. Okay, because you're buying distressed cheaper in an appreciating market. You got this spread here. So a lot of the investors are going to try to buy these properties at the market. Okay, so just realize that. And again, for the average buyer, I don't really suggest you go buy at the foreclosure auction. Number one, because it takes all cash, and two, there's risks involved. And unless you know what you're doing, you could find yourself an extra expense or situations you don't know how to get yourself out of. So not good. So more emphasis will be on acquiring from the pre-auction or pre-foreclosure situation. So, don't go to the auction. Talk to the homeowner beforehand. The homeowners will start to see more information or marketing coming to them right now. Short sales will increase. That'll be a byproduct of the pre-auction marketing and emphasis, okay? But this is where the inventory is hiding, everybody. So I've talked about this so many times, but this is where it is. If you want to get a good deal, you got to get ahead of the auction, ahead of the large hedge fund investors, and stake your claim and connect with and market to homeowners directly. Because, again, your real estate agent's not going to go out and do this for you, okay? It's not in the scope of what they do, all right? And I can tell you that because this is my marketplace. I know exactly how this works, all right? So we're going to see a rise in foreclosures, more distress activity will happen as time goes on. We'll start to see some bank-owned coming on the MLS. So there's been foreclosures that have happened the past few months. Eventually, they're going to straggle onto the MLS, okay? But the volume won't be there to lower prices dramatically or probably impactfully in a location. And realize that the way things are now, if a bank-owned property hits the market, there's usually a period of time where first-time home buyers get a chance to buy it. People with home ownership grants get to buy it first or place offers the first couple of weeks. Regular homeowners, then investors actually go last. Okay, so what they're doing is they're trying to, the lenders are trying to make it available for owner occupants, which I think is positive in this case. But a lot of these REO homes that are going to come back on, the bank home, are not necessarily the best quality and may be too much project work for basic homeowners to jump into. So we're not going to see the volume yet that will influence market pricing to push it down with respect to bank-owned, drawing stuff downwards. Okay, the wild card though is the foreclosure volume. Okay, the more there is, the greater the disruption. Clearly, this will help decrease home prices. So right now we're not going to see any impact, but as we get back to normal foreclosure activity towards the end of the year, and then going forward in 2023, 2024, we should start to see some impact happening here. It should push it down, but the volume really is based on. It will make a difference. So are we going to see 2 million foreclosures? Are we going to see 10 million foreclosures? That's a big gap. Or could we see 6 to 7 million? I think we're going to be in that range. That's kind of where we're going to see it. So again, don't be influenced by the housing narrative. Okay, stuff will happen. It just has to get there. All right, the things were put in place to prevent this from happening. It's resulted in, whether it's by design or just by fluke, a huge increase in home price appreciation that's kind of propped up the marketplace. Now we'll see whether that can maintain or that's going to erode. But again, with respect to the foreclosure stuff, there's more out there than you think. Most of it is not on anybody's radar. It's called the shadow inventory. You just don't find it by, like going on your MLS or things like that, or Zillow. Well, you can sort of Zillow, but there's different ways. But the whole point is that they're not on market. So stuff that we talk about is not, hey, it's for sale, you can buy that really cheap priced house. You kind of got to work for it to get it, which is what we specialize in. So that's the point here, guys. But so, yeah, we're going to have some fun, or there's going to be some carnage in the future, depending on your perspective, clearly. So that will happen. It's just, again, it's been a slow, drawn out, painful process to get there. Literally is started. You can see by the numbers. You can see by some of the things being written in the media right now. You can see by statistics on auctions and, example, that article for 14,500, up in Long Island. There's actually probably more than that right now if you take a look at greater metro areas and the whole bit. So it's just, there's a lot that's going to happen. We just have to get there. So patience truly is a virtue. Been testing mine the past couple of years for sure. So, just everyone sort of just, be cognizant of what's going to happen in the future. So an example of, look, this is a short sale, recently closed short sale, which was one of those type of properties, kind of a zombie property, vacant. We negotiated a 49% discount off the mortgage. The ARV is comfortably at, 350 to 370 range. Instant equity, we bought it for 172, or my client did. Instant equity 177.5. So again, didn't take 941 days. You know what I mean? So if you know what you're doing, you have the angle, understand the marketplace, things can actually happen. All right. So please, open mind, talk, ask questions. That's the whole point. Don't just listen to what they're spewing. All right. That's my prediction, is that the narrative is going to get worse before it gets better. So I'll tell you how to engage the distressed housing market. Reach out to me at randy@luxuryshortsales.com. And again, once again, appreciate the views, the likes, comments. Please share the video with your family and friends. I got some good stuff happening here. You need to be involved in this marketplace to figure this stuff out. Very important. And connect with me, and I'll show you how to do it. All right. Anyway, guys, appreciate the time. We'll talk to you shortly.